everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We continue to move through the slog that is a week devoid of big news on the macro side, at least for now. You can get ready for the return of macro on tomorrow's show, at least on the U.S. side. We're going to be talking about U.S. inflation and check back in on the Fed. But today, it's a different central bank and a different set of inflation numbers that is in focus, ostensibly no less important and maybe very telling for where the universe of central banking in the wake of this crisis at lenders, beginning with SVB at the beginning of this month, is heading. Tonight, we are going to be looking at inflation in the euro area. And this is actually very, very important for the overall story here, because, of course, we are talking about a central bank that has to manage probably a more difficult situation than does the Fed or most other central banks. And this is because they have not just to manage the trade-off between inflation and bank solvency and bank stability, they also have to manage the shaky sovereign structure of the euro area. And we'll talk about that in just a second here and see how the ECB seems to be making good progress if we look at these numbers and what that means. So let's begin with a look at what is expected. And we're going to straddle not one, but 2 days of data announcement here. We are looking at the German CPI release later today, tonight, U.S. hours, and we're looking at the Eurozone one, the catch-all one, on the following day. And what you can see here on the chart in the red and the dark line there are the expectations. So you can see we're looking for the region-wide number to come in substantially from near 8% down to 7.1. The German number to come in similarly from a reading north of 8 to 7.3. You can see that's followed closely with the 10-year break-even rate here. That's the yellow bars. That is, as we've said, on the show a few times, too many perhaps even, the difference between nominal and real rates. So when you take the nominal yield, which of course includes inflation, and then you take the inflation adjusted or the real yield, which takes that nominal yield and subtracts from it inflation, then you end up with that inflation adjustment value. And that's what we're tracking here, the bond market's implied inflation expectation. What you find is that with about a 6-month lag, the Eurozone CPI has tracked those expectations. And that lag is there for a number of reasons. Of course, the CPI data takes time to collect. It's published monthly. These inflations are daily, real-time. There's invariably a lag in the data collection process itself. And of course, markets are also forward-looking. So they anticipate changes in inflation before they actually occur. You can see that if we were to get a decline now, it would be consistent with the topping in the German 10-year break-even. The top in CPI, you can see, roughly lines up with that. What you also see, however, is just like in the U.S., in February and in March to some extent, there's been a rebuild in inflation. So it hasn't really fallen off and continued to go down, looking at the expectations. So there'll be a real question here, because, of course, inflation at 7% is still miles away from the ECB's objective of 2%, as to whether this actually gets us on a path toward the right direction, or if in fact the rebuild that we saw in February and to some extent in March, so of course that's been curtailed by the banking crisis to some extent, whether that's a sustainable path forward or whether it's the higher inflation that will beckon the ECB into further action. This, of course, is much the same calculus as what the Fed faces. From the market's perspective, they seem to think that the ECB is open to something less hawkish than was the expectation set before. So if we look at the current curve, you can see we're looking at a peak deposit rate for the ECB at about 3.5%. And that's 6 months from now. So we're essentially saying September is the peak in the ECB rate hike cycle, that we're going to have 50 basis points added between now and then of course, come a year from today, we're already going to be in cutting mode. So we're already going to give back a 25 basis point rate hike out of the ones still in front of us now. The key thing here seems to be the evolution of the curve since the last ECB meeting, which wasn't that long ago. It was on the 16th, and that policy meeting actually was immediately after the initial sort of wave of everything that happened with SVB and with Credit Suisse. And the Credit Suisse episode, of course, also informing, thinking about Eurozone banks, like Deutsche Bank, say, and extending some consternation there. So we can see that in the span since that last ECB meeting, where they delivered the 50 basis points that they promised to do, the market rewarded the ECB by not panicking at that 50 basis points, despite the fact that there was a banking crisis that was fresh in their minds, very fresh as a matter of fact. And so what we see is since that time, follow-on moves by the ECB look like they're going to be much more modest. So we were looking for a peak rate just under 4%. Now it's 3.5%, and now it's occurring sooner. So we at first were looking at a peak again as of just the 16th of this month. So very recently, we were looking for a peak sometime in March of next year. And of course, now it's September of this year. So much more of a shallow path forward for the ECB and a sooner transition into cutting. It hasn't really moved much in the past week, although it does look like the pace of rate cuts after the peak, after the terminal rate, looks like it's fattened out a little bit. So we were looking at lurching lower under 3% by a year from now as of a week ago, and that's been built back out. So a less aggressive path lower. Now, of course, the reason why we've had this narrowing has been the financial stress that we've seen in markets. And indeed, you can see here the OFR Financial Stress Index has moved cleanly in the inverse of rate hike odds for September and December. The September and December implied rates are there now, and you can see that recovery in them over the past week from the depths of the crisis, but still clearly much lower than they were before the crisis started. And the OFR index showing you that while it stopped getting worse in tandem, it also hasn't come back down. And so the natural question then becomes, if it were to come back down, if the markets were to become more confident, would that mean that the ECB would have a bigger inflation job in front of it? And of course, these CPI numbers are going to be key in that sense. If the numbers we end up seeing end up registering a bit hotter, we're going to start to have a question of how the ECB can square this circle without worrying about the financial stress element getting worse again. This is the current layout through the beginning of next year. So you can see we're all but dominantly expecting that we're going to get another 25 basis point hike at the May meeting. About 78% of it you can see baked in here, looking at the rate hike cut column. The percent hike cut column, you can see 78.2, and then the implied rate delta column, you can see 19.5 basis points of the 25 that is a standard rate move has already been baked in. When you move out in time, you can see by June that hike is in, and you've priced in about a 42% chance of a further one. You get to two hikes, those two hikes that we were just talking about, when you get to October. So if we go back to our curve here again, you can see the peak rate there, September, October or so. You can see that in October now. So you can see September, October, the implied rate is 3.38. So you have the full two hikes baked in there. And you can see in the number of hikes cuts column, there's a 2 there, which tells you you've increased to 50 basis or by 50 basis points. And then, of course, you can see that come December and February, you're already unwinding that. So come February, you are essentially back to where we're expecting to be in June, which is about one rate hike above where we are currently. So one of them at that point has already been given back. The most interesting part, and as promised at the top of the show, is this notion of sovereign risk. So you can see here that since the ECB's rate hike odds, at least the expectation for what the terminal rate would be near term and in the immediate term, you can see since that has kind of started to flatline for the most part, since the aggressive part of this rise effectively ended, going into the back half of last year and into this year, sovereign stress in the euro area has eased. Now, what does that mean? The dark line here is the ESTR active contract. The ESTR is the overnight rate in Europe. This is the equivalent of Fed funds futures for the U.S., where we look at rates futures and we try to extrapolate what they say about the market's view on where the Fed funds rate is actually going to go. Those futures used to hedge Fed funds move risk. And so this is the same thing. This is the market's hedging against rate hikes. And so the ESTR active contract, those futures hedge against ECB rate move risk. You can see the implied rate there was going up all through the Fed's campaign to hike rates because, of course, of the Fed's dominant position. When it hikes rates, borrowing costs go up everywhere, not just in the U.S. We've talked about that. That's the ubiquity of the U.S. dollar as a medium of international exchange and commerce being revealed there. But what you can see is as the implied rate for the current ESTR contract has stalled, so too the spread between 10-year bond yields in Italy versus Germany has stopped rising, where it was moving higher right alongside rate hike expectations, it has actually started to move lower. That's ebbing Eurozone disintegration risk, essentially. The reason we look at the Italy-Germany 10-year spread is Italy is sort of the poster child for a high-debt Southern European Eurozone member state, and also the third largest economy in the euro area. So the one where if all that debt were to lead to some sort of blow-up, you're probably looking at, if maybe not a mortal wound to the Eurozone, then certainly something that's close to it. And Germany, which is the fiscal prudence benchmark in the Eurozone, where debts are managed, where you have a high credit worthiness economy and the largest economy in the Eurozone. So when you look at that yield spread, what you're seeing when it widens out is a greater risk to lending to Italy rather than Germany. So the market demanding a higher yield, reflecting a higher risk in lending to Italy than Germany. Consider the easy analog of a college student with no job coming in to buy a car versus somebody that's been in the same lucrative, let's call it, medical profession for the past 10 years coming in to buy a car. Obviously, the student is a much higher credit risk, a much higher possibility they may not pay back that loan than the medical professional. So the college student will see a higher interest rate, the medical professional will see a lower one. This is exactly the same thing. So to see this Italy-Germany spread narrow in, that tells you there's declining credit risk in Italy as relative to Germany. And so the markets look at the ECB kind of maturing in its rate hike expectations and saying, okay, well, this probably means that disintegration risk is lower. This probably means that rising rates won't topple the giant debt pile in Italy, that it will be serviceable, whereas the risk would be if rates on a giant pile of debt are rising, that servicing that debt will become increasingly difficult and maybe lead to some kind of a debt crisis. It gets more interesting still. So here we have that same Italy-Germany 10-year spread. We also have that same OFR financial stress index, and we have the Bloomberg Eurozone Financial Conditions Index. So that's just how easy is it to borrow money in the Eurozone. And you can see that with the rise in the financial stress index and the sovereign yield spread there, which of course we saw just here was a function of ECB rate hike expectations building, we have seen that financial conditions have tightened. That makes sense. Rate hike expectations and then the realization of those expectations naturally give you tighter credit conditions, and that, of course, is the whole point, to make it more difficult, more expensive to borrow, and thereby to slow economic activity and rein in inflation. You can see that in the back half of last year, especially in the fourth quarter. This is, of course, where the market decided that central banks were almost done and that the party was back on. We can see that financial stress eases. Financial conditions in the Eurozone get looser, so the dark line there goes up. And sovereign stress eases, so the orange line comes down. Then, of course, comes SVB, Credit Suisse, and everything else. And you can see the red line jumps. So financial stress up. The financial conditions index lurches back lower, so things tighten up. Banks look at each other and go, wait a minute, there's banks failing around here. Let's pull back on lending. Let's pull back on providing credit to all various things because we might need this cash. We might need to spend some time in the barrel ourselves to some extent. And so you have then that tightening of economic conditions. The critical thing to take away from this chart is that the orange line does not then go up. sovereign risk is not a connection that the markets have made here for now, which of course is playing into the ECB's hands. The ECB can be more free to hike rates. At this stage, seemingly, at least from a sovereign risk perspective, because this market stress does not appear to be spilling over into some kind of a tightening that would make Italy appear less solvent as relative to Germany and shake the structural integrity of the Eurozone once again. This is, of course, very interesting because, as we can clearly see here by the black lines or the dark lines move back down, you have tightening as a consequence of the financial stress. So it is, in fact, the case that you have de facto rate hike equivalent market conditions on top of what the ECB is already doing. But the market is not prepared to worry about sovereign stress here, which, to be sure, the ECB is going to celebrate. You do, however, have some reasons why inflation might register hotter than expected. You can see the economy in the Eurozone, manufacturing aside, has been doing better. You can see the extent to which the service sector is, as with most advanced economies, dominant in the overall makeup of economic growth. You can see the composite number that includes both services and manufacturing, basically mirroring that services index. And both of those well above the 50 boom-bust level. We've talked about this before in the logic of PMIs. 50 is the midline. That's neutral, neither expansion nor growth. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. Yeah. For manufacturing, you can see that's been contracting at a faster pace here, which is disappointing, down to 47 on that index. But for the majority of the Eurozone economy, what you're looking at is accelerating expansion. 55.6 on the services index there, 54.1 on the composite in the latest set of numbers. This, of course, is something that would bid up inflation. A pickup in economic activity means more money is changing hands at a greater velocity, and so that's something that's inflationary. As you pass that through the banking system, it creates money. And as sort of a natural function of fractional reserve banking, which we can get into the details of at another time. But suffice it to say that when you deposit 10,000 euros into a bank, the bank is only required to keep some of it on reserve and can lend out the rest. If it then lends out, let's say 90% of your 10,000 that you've deposited, how much money is now in the banking system? Well, you've now created another 9,000 of potential purchasing power, which of course then is spent, input into the bank, 10% is kept, more is lent out. I'm making up the reserve requirement ratio here at 10% to illustrate a point in round numbers, but fact of the matter is economic activity creates more money and makes that money cycle through the system faster and be created faster. So what you are looking at with an acceleration of growth is a bidding up on inflation, which of course then asks the ECB, well, are you actually making the kind of progress that you think you are? We also look at the Citigroup's economic surprise index for the Eurozone, and we can see that after a bit of a pullback at the start of the year, it's starting to perk up again, having run meaningfully higher from about the middle of last year. And you can see that, in fact, it's well above zero. So Eurozone economic data has tended to surprise higher relative to economists' baseline forecasts. which tells you that when you look at the expectations for these inflation numbers, 7.3, 7.1, it has been the case that these forecasts have tended to undershoot, looking at this chart here. Which, of course, then brings us to what is the most interesting question of all, which is, what does this mean for the euro? If you were to get a set of numbers that's in line with expectations or softer, ostensibly the message would be the ECB does not need to do as much tightening. That would be probably bad news for the euro, because currencies tend to do well when interest rates are going up. That's because one person's borrowing cost, which is what the interest rate is another person's lending income. And so if interest rates go up, it becomes more lucrative to own the currency where the interest rate is going up, because you can then lend it out for more money, make back more interest. So when interest rates go up, people go and they buy that currency. They want to own that currency. So in effect, what you're talking about is almost like if a company were to raise dividend, you want to own that stock. So if dividend yield is what you're after, of course. Similar story in currencies. So if you were to get a higher inflation number here, you might end up with a situation where the ECB might be inspired to do more, and you might see a hawkish shift in policy expectations. That the recent crisis has not seemingly woken up sovereign risk works to support that scenario. Seems like the ECB is getting a pass on tightening economic conditions without that becoming a sovereign concern. And so they would have something of a clear path forward if they needed to raise rates more than what the markets are currently expecting. But if you do get a soft number, in fact, if that number misses the mark, you might have a very significant euro decline, because that would tell you that essentially the ECB has successfully navigated and is under no immediate pressure to dial things up. That essentially they could stand to maybe even loosen the expectations that are there already. And that would be something that would give us, likely, a euro move lower. In particular, as we get ready to see the PCE inflation data out of the U.S. on Friday, and what that might do for Fed rate hike odds, which have been beaten down by the SVB crisis, but which the Fed enthusiastically has pushed back against, with Fed Chair Powell really banging on persistently on this point that there are no rate hikes that the Fed, or rate cuts rather, that the Fed is penciling in for this year. So if inflation were to cave in here more than anticipated, you might have a weaker euro and a nice setup going into the U.S. PCE number. Then, of course, we'll see if that carries over into U.S. PCE and a downbeat print there, and what that could mean for the Fed as well. If instead you got a hot number, you might be looking at a euro that makes a run to the top side. The key here, resistance at 110.59 on the 6E future. You would need to take out that range high to make the case for more follow through on the top side. The initial support at 108.12, if you got under that, you could make the case for a pullback to the bottom of the range at 105.29. There's a little bit more space there on the downside than there is on the top side. So risk reward at the moment close to even, but ostensibly a little bit better on shorts than it is on the long side. But still not attractive enough, I would say, to just jump in. Confirmation still seemingly needed. And that is the lay of the land here for the macro picture today. Thank you, everybody, for joining me. We're here at Macro Money 4 days a week, Monday through Friday. That's right after I speak with good friend of the show, Chris Vecchio, for overtime. He's the head of futures and forex here at tastylive. We speak for an hour just before Macro Money, Monday through Thursday every week. I'm also on most Fridays, but for this one with Chris for Futures Power Hour, and then on with Tom and Tony for First Call Sunday evenings. Outside of those shows, you can catch me opining on Twitter at Ilya Spivak. Thanks very much for being here once again, everybody. Good luck out there. Happy trading.